Hello everybody and welcome to my usual most undervalued stocks video for Friday. This video is just about the most undervalued stock. It's not about the best stock. I am not trying to predict which is going to be the best stock over the next 10 years, just which stock is the most undervalued over the next 12 months. And so feel free to stop the spreadsheet and take a look and see what you think. Quickly, important note, if you're new to the channel, I only focus on growth stocks and specifically hyper growth stocks on this channel. I'm looking for at least 30% compound annual average growth rate of return on investment, which is very, very ambitious, but nonetheless, I believe possible because of innovation. All these stocks are highly innovative stocks. The goal is to really double monetary inflation, which I estimate at 15%. So if you have 15% above monetary inflation of 15%, over 5 years, that will be a doubling every 5 years in real terms, not in non-nominal terms. And one of the main methods that I use to invest is I use enterprise value over gross profit and variation of that metric, enterprise value over gross profit. Why do I use that? Because none of the stocks that I cover on the channel are ready for earnings. They're not optimized for earnings. They're only optimized for gross profit. And in fact, I typically don't include any companies that are pre-revenue, that are more R&D stage in the channel, and I don't include any companies that is too mature and too ready for earnings. My style of investing can be summarized really well in this chart. I try to get into stocks at early signs of product adoption. Typically 5% of the market share is when the stock starts to get interesting, and then right all of the way, the S-curve adoption S-curves tend to be very steep. They are not linear. They are steeper because they follow an exponential, and the goal is to obviously get out of these companies once there are signs of a clear slowdown in product adoption. One final point to make about this spreadsheet is that I use enterprise value and I don't use market cap. The reason why I use enterprise value is because I want to penalize companies that have a lot of debt. Sometimes it is very misleading when you use market cap. You see great metrics and you're like, what's going on? This is a great company. Well, oftentimes it's because you don't look at long-term debt. So I need to subtract long-term debt. So all of these enterprise values, of course, are with net cash and not long-term debt. Therefore, I think it's a much more accurate picture of whether a stock is cheap or not. Let me now move on to answering the question, which are the most undervalued stocks in the universe? And that has not changed from last week. The most undervalued stocks are still Lovesac, which is a lifestyle company. They make couches, believe it or not. StoneCo, also known as STNE, which is a payment company in Brazil. And they're ex aequo, they're both number one. Then you would have HIMSS, which would be my number two. So HIMSS stock is a healthcare company that mostly focuses on preventative healthcare. Then I would have Nubank. Nubank is still very, very cheap right now, followed by STEM and SOFI. STEM and SOFI are both very inexpensive stocks, followed by INDI Semiconductors. So as you can see, a lot of small caps are pretty cheap. And if I were to take a guess as to not take a guess, but tell you those that I prefer the most out of all of those, it would be StoneCo and HIMSS. StoneCo and HIMSS, out of all of those, are my biggest position, followed by Nubank behind and a little bit of SOFI. And Love and Indie are very, very tiny, and STEM, I don't own STEM. So moving on to the most overvalued stocks in this spreadsheet. So the most overvalued stock in this spreadsheet are NVIDIA, and I'm fully out of NVIDIA, I've sold out, and Shopify. Shopify is still very expensive right now. And by the way, you may be wondering why I am pointing to enterprise value over trailing 12-month gross profit over revenue growth. The reason why I'm doing that is because this is a gross profit spin on the PEG ratio of Peter Lynch, the price to earnings to growth ratio. So the question that I'm asking, and the question that this ratio is answering, is how much am I paying for each percentage point of next 12-month revenue growth. Each percentage point of next 12-month revenue growth, how much am I actually paying for it? And obviously, you want it to be as low as possible. And I typically consider anything below my average to be a good thing, right? Anything below 0.59 is very, very good here. And if you get into something like a 3, for example, a 0.3 or a 0.2, that would be considered excellent in my spreadsheet. That is how much you're paying for each percentage point of growth. And you want this number to be as close to 0 as you can. That is when the stock, in my view, is very undervalued or very cheap, which is the theme of this video, right? The theme of this video is just the cheapest stock. So now, let me go through each of the megatrend in this spreadsheet. So as you know, since I invest for product adoption, I have to categorize my stocks within megatrends. And I have identified multiple megatrends that I'm now going to cover and tell you what I think about each stocks in those megatrends. So the first megatrend, which is, I believe, the most important megatrend out of all of the megatrends we're seeing right now, is energy revolution stocks. Energy is becoming nearly zero marginal cost, if you know what I mean. It means that we are getting to a point where energy is becoming very abundant and very, very, very inexpensive. And I see 3 stocks in this field that I've covered on the channel, which are Tesla, Enphase, and STEM. STEM is an energy storage company. They're actually a major installer of Tesla Megapacks. As far as those 2 stocks go, Tesla and Enphase, right now, Enphase is still cheaper than Tesla despite the run-up. And one of the main reasons why Enphase is cheaper than Tesla is because I have penalized Tesla in this spreadsheet. They've just reported earnings and they didn't do too well. And because they did not do too well, I have lowered my gross margin expectations for Tesla, which makes Tesla now very expensive. Notice how I am still very optimistic when it comes to the revenue growth of Tesla, since I am still giving them 50% revenue growth, even though they didn't do anywhere near that. I am giving them 50% revenue growth because they have reiterated that target in the call and in the letter. So as long as they're going to reiterate their long-term growth, I'm going to use that long-term growth for them, and I'm going to believe that they are on track. That is what they tell me. They tell me they are on track, and the CEO of Tesla has done it before and can certainly do it again. Now, when it comes to HIMSS and Teladoc, so HIMSS is clearly the more compelling play right now. They are a preventative healthcare company selling a lot of recurring prescriptions to a lot of customers for conditions such as ED or hair loss. So customers that have issues that have been historically stigmatized is what HIMSS started out with. But today they focus on a much broader range of recurring prescription, and HIMSS is extremely cheap at a 0.13. So it is the second cheapest stock in my universe. Despite the run-up, HIMSS has had a little bit of a run-up, but despite that, it is still the cheapest. What I love about HIMSS is that it operates outside of the health insurance system. TDOC operates within the health insurance system, and because of that, I don't believe TDOC can be as agile and grow as rapidly as HIMSS. So I prefer HIMSS for the healthcare revolution stocks. Then, the third trend, the mega trend that I see is the data warehousing, data monitoring type of stocks. Right now, in that sector, the cheapest pure play stock for that sector is actually DDOG, and DDOG is a data monitoring company that helps you spot whenever there are issues in the company's IT. It's a great company. What I love about Datadog is that they spend a lot on R&D and they keep introducing new product and selling more. I have recently sold out of Snowflake because Snowflake has cut its guidance in half, and I was very disappointed to see such a stark change in guidance. However, I would be looking into getting back into Snowflake if it were to trade at a reasonable level. But this is too high for my taste when it comes to Snowflake, so I'm currently out of Snowflake, even though I like the company. MongoDB is also a little pricey for what they do, and they have a little bit of slower growth, so they're a little pricey, but I do believe that NoSQL database are going to be much bigger in the future, which is why I like MongoDB, and I still own MongoDB. And Palantir is kind of my outlier in this section. One of the main reasons why I own Palantir is because of their government military business. I believe Palantir has an opportunity to perhaps becoming the fourth military industrial complex contractor for the US government, and I think that this stock has a lot of potential based on the military business alone. Moving on to cybersecurity stocks. So cybersecurity stocks are what I consider recession-proof or recession-resistant stocks. It is the last component of IT that companies are likely to cut. And my favorite stock in cybersecurity is endpoint security software, CrowdStrike. CrowdStrike gets better as it gets more AI into its systems, and it's able to flag threats and detect threats sooner than others because it has the most data. And so CrowdStrike is kind of this hybrid that uses data to be a better security system. I think CrowdStrike has given us great guidance, and they are a very well-managed company, even though they are expensive right now. But I like CrowdStrike very much. Zscaler is the cheaper in this space, but Zscaler is a smaller position for me. First of all, Zscaler is often sold with CrowdStrike, which is often very interesting. But I do believe Zscaler has more competition in zero trust, and one of the things that concerns me sometimes with Zscaler is the influence of Cloudflare. I know that Cloudflare is trying to get into the same business as Zscaler, and only time will tell whether that could be a threat or not. Cloudflare is a very solid company, very strong company, high growth, great leadership. The problem is that they are very expensive right now. My favorite stock in cybersecurity, like I said, is CrowdStrike at the moment, even though it is not the cheapest. The cheapest would be Zscaler. Moving on now to e-commerce. So e-commerce is still a very high growth space, despite the fact that in the Western world we have very strong penetration of e-commerce. It's still growing very fast in a lot of places around the world. So first of all, in the US, Shopify would be a major player, but Shopify is just too expensive. To me, Shopify, everybody sees the opportunity in Shopify. I am not the only one. We are not the only one to know the opportunity in Shopify. That's why it's trading so high. I mean, per my metric, to give you an idea, Shopify per my metric is twice as expensive as Tesla. So I find Shopify quite expensive. And then I like e-commerce stocks that focus on emerging nations. And so you have Sea Limited, which has a very strong focus on Indonesia, and then you have MercadoLibre, which has a strong focus on Latin America, particularly Brazil. My favorite stock out of the three is MercadoLibre. Even though it is a little more expensive than Sea Limited, it is, I believe, much higher quality, it grows faster, and it has higher gross margin. Let me now move on to the payment stock. And as far as the payment stocks are concerned, I am only buying Stone right now. I still own Square and I still own DLocal, and I am still troubled by the short sellers. They are both under attack by relentless short sellers who come back and keep republishing notes against these stocks. So there is an overhang, in my view, especially for DLocal. There is an overhang from short sellers, and for Square, the attack from a short seller has just started. Who knows how long the attack for Square is going to last? Also, Square is not predicted to grow just as much right now during the next 12 months. So Square is kind of a question mark for me right now. I am not touching it too much. I sleep well at night because it's a small position. Same for DLocal, sleep well at night, it's a small position. My absolute favorite stock in this payment space is StoneCo, Stonier. They are the Square of Brazil. They have permanent terminals, a duopoly over there in Brazil. They have StoneCo and they have PagSeguro, which are the two main payment terminals. But I believe StoneCo is the slightly better company, slightly better stock, slightly better marketing, a lot of very interesting things going on. And as far as the price of StoneCo is just dirt cheap. StoneCo is dirt cheap at a 0.09 enterprise value over gross profit over revenue growth, which is the cheapest. One of the cheapest stocks in my spreadsheet. So I am very much buying StoneCo right now. I believe Brazil has a lot of potential. I also like what I see within the Brazil politics right now, with the president of Brazil pushing for a lowering of interest rates over there. And so they may have a lowering of interest rates much sooner than us, which would be really great for the economy, which would benefit Stonier. So I like Stonier very much. Let me move on to chip makers. As far as the chip makers go, of course, Indie is the cheapest, but Indie Semiconductors is riskier in my view. It is a tiny stock. It is not a proven stock. They have amazing revenue growth, very high gross margin considering we have a margin of the giants in the same field. Industry veterans leading the company, but to me, this is a company that is still early on in providing semiconductors to the Tesla competition. This is Indie's business model in a nutshell. Is they provide ADAS displays, screens, radars, all of the tiny chips that go into the competition of Tesla is what they provide to the competitors. But I mean, to me, it's still very, very early on. Teeny tiny position in Indie. I love those numbers, but the stock is just so micro cap, so tiny cap that I have to be careful. Nvidia is too expensive. I have sold out of Nvidia. I'm trying to get back into Nvidia. I think a lot of us are trying to get back into Nvidia. Yes, we understand that GPUs are the future. Yes, it takes 8 GPUs for every 2 CPUs sold. Yes, Nvidia has a lot going for it in terms of AI, but everybody sees that opportunity, which is how you get to this mind-boggling valuation, which I do not understand. I cannot conceive of such a high valuation. Nvidia is much more expensive than, say, a Tesla, for example. AMD would be my favorite stock out of all of the chip makers that I follow on the channel. It is the most balanced stock in my view. Decent growth, although it's down with the economy. Good gross margin, and yes, a CPU market that is in decline, but they have much more than CPUs. They have Xilinx, they do a lot of gaming consoles, they do a lot of stuff that really make me confident about the future of AMD. So I prefer AMD within the chip makers right now. As far as ad tech, so the Trade Desk and Pubmatic are both positions that I own. Obviously, Pubmatic is much cheaper right now, but it has a lot to do with a tiny market cap. It's another micro cap, so I would be careful to not to have too big of a position. This stock has been volatile in the past. It's been very volatile actually over the past 12 months, and it can continue to be volatile. So it is a smaller position. Trade Desk is an old position. For me, it is a fine stock. It is an expensive stock now. I yet have to cover it on the channel. I will cover it on the channel shortly. Another sector that I follow on the channel is lifestyle companies or lifestyle stocks. I believe there is an opportunity for new brands to emerge today, since marketing today is mostly done online and not done through the evening news and television advertising. Because of that, we get new brands, and I've identified 3 lifestyle stocks that I like. So Celsius Holdings is a company that I'm looking to get back in, but it is still very expensive. Celsius Holdings is an energy beverage. If you live in the US, you probably see it everywhere. They have a major partnership with Pepsi, which is both a blessing and a curse, if you really think about it. It's a blessing because they can grow much faster thanks to Pepsi. It's a curse because I believe they could be an acquisition target, a major acquisition target. And so if you buy a stock like Celsius and they get acquired, yay, you make 30%, but you also haven't found a 10-year long-term hold. So it's not, it's really not my style of investing. I consider acquisitions typically to be a threat to a long-term stock that I want to own, and I just want to own that stock, and I don't want it to be absorbed by a giant that's just going to use that innovative company as a way to, patch holes in the sales and invest products. Okay, Lovesac. Lovesac is another very interesting stock, very interesting company, old company, making furniture, actually, a company that dates back to the late 90s. And Lovesac, when I covered that stock on the channel, I only covered it as an anomaly. It is an anomaly. I do not understand why this stock is trading so cheap. The company has a very interesting product, and the numbers are fairly good, actually, if you really, really think about it. So I think Lovesac got caught in the narrative storm of 2021. Everybody buys homes. Everybody's buying a home. Lovesac makes furniture. Let's bid up furniture. And then 2022, nobody buys homes because nobody buys homes. Furniture is dead, and let's go and let's sell off every single stock that makes furniture without looking under the hood. It is often how Wall Street works, and it is unfortunate, but I believe Lovesac right now is pretty cheap, and it's a very compelling product. If you haven't looked at the video I made on the channel, I highly recommend it. Lastly, the last one, the lifestyle stock that I have is Figs. Figs is a company that makes scrubs, and they are very much in a slowdown right now, but to me, they are using a Lululemon playbook, taking a product that was not used very much by the mainstream population and making it mainstream. What Lululemon did for yoga pants, Figs is trying to do for scrubs. And so that's part of this whole lifestyle brand movements where old brands are getting replaced by new brands. And I think clever marketing has a lot to do with the three stocks that I have outlined here on the channel. Generally, my lifestyle stocks are tinier positions, but I don't want to ignore lifestyle companies because these are a megatrend. They are a major megatrend that we are going through right now of innovation, a trend of innovation. The other major trend of innovation that is going on right now is neobanks, right? Banks are getting rid of, they're not, that's the problem. Banks should, though, be getting rid of their branches. Cash is slowly going away, in my view. And I believe neobanks will have a much better time than old world legacy banks who keep doubling and tripling down on the branch and on the advice in branch. And so the two companies, the two neobanks that I very much like are SoFi and Nubank. So SoFi is heavily covered on YouTube. Probably don't need to cover it too much. You probably all know what SoFi is. Nubank, however, has metrics that oftentimes are even better than SoFi. And if you actually calculate on my trailing 12-month gross profit over revenue growth and enterprise value, if you calculate my third row metric right here, you can see that actually Nubank is a little bit cheaper. So a little bit cheaper, and I've been adding to Nubank more than SoFi recently because they are in Brazil and in Latin America, and I believe that right now, especially from a perspective of a U.S. investor, right now Latin America is perhaps the more interesting emerging market to invest in, and I like it very much. Also, SoFi is a bigger position for me, and so I would like to someday eventually have them equal size. Lastly are the platforms, my platform companies, platform stocks. So a lot of marketplaces of the past are getting replaced by newer marketplaces that are regulated by platforms. Platforms are highly efficient business models that require very, very little employees. It's a toll road of creating relationships between buyers and sellers. And Airbnb, to me, is one of the more interesting plays in all the platforms. It is the only one that I own out of the three that I have on this spreadsheet. I believe Airbnb is undervalued, actually, on an EV over gross profit over revenue growth. It is pretty cheap, right? Almost twice as cheap as my average. And this company keeps growing. This company keeps benefiting still from pent-up demand in travel. Airbnb sells a lot of actually inexpensive accommodation. Most people don't think of Airbnb as inexpensive, and you'll often see the occasional social media tweet, for example, that says, "Oh, my Airbnb is just as much or more than a hotel," but that's because they don't focus on the better specifics, which is if you travel, say, as a family, or if you travel as multiple people, Airbnb can be significantly cheaper, and they have an interesting positioning where for a new market where vacation was not a thing, a new market of vacation goers, for that new market, they are inducing demand at a price point that didn't exist. Because if you're a family of 5, or if you're a group of 5 friends, in the past that was free hotel rooms, right? And now with Airbnb, you have a whole new array of options that are possible. Noteworthy to note that Airbnb is going after a much bigger market than what people think, right? They are going after, in my view, the mom and pop rental market. Many Airbnb stays are more than 1 month. You have even more Airbnb stays that are more than 2 weeks. And it is a millennial trend right now that people decide to actually live on Airbnb, in Airbnbs, or stay for very long periods in Airbnbs. So this business has a much bigger total addressable market than I think most people think. Additionally, Airbnb is a truly international company. They are just about everywhere except Russia, and I know they're still they're still getting out of China. But aside from that, Airbnb is still a widespread global company. Very interesting play. I also like Etsy, but Etsy is expensive. A lot of people see the opportunity that I see in Etsy, so the stock is expensive right now, and I haven't moved. And Fiverr is kind of the same thing. I am trying to add to Fiverr right now. So Etsy, if you don't know, Etsy is obviously crafts. They induced demand. They created a new market out of nothing for selling vintage and craft. eBay was never really meant to sell those, except Etsy is doing a really good job at creating a market that didn't exist before, a website that didn't exist before. And Fiverr is for micro jobs or micro tasks, like small tasks. It was obviously very big in 2020, and of course right now, 2022, 2023, the past is gone. We're all going to go back to the office. That's the narrative. Therefore, Fiverr is going down. And now Fiverr is suffering from another narrative that we're all going to use ChatGPT, and ChatGPT is going to replace labor. I'm not undermining that narrative. I think it's a little overdone. Right now, Fiverr is dirt cheap, trading at enterprise value over gross profit of 4. So it is dirt cheap, but it is nonetheless a stock that I'm trying to get into. Same as Etsy. I still find them expensive related to their low growth rates. So I am, for now, steering clear of these two. So this was it for the mega trends in the spreadsheet, in the most undervalued hypergrowth stock spreadsheet. So again, this is not the best stocks. This is just valuation, just looking at valuation. We often know that stocks can stay overvalued for 20 years. So that's important to keep in mind. You can have a stock that's overvalued all the way up, and it's still going to be overvalued the time you sell it. So some stocks trade at much higher valuation than other stocks, and some other stocks never reset. We never get that valuation reset where they get valued in line with the market. So that's also something to keep in mind. This is not investment advice. This is just entertainment only. Appreciate your likes and your subscribes. Thank you very much, and have a wonderful day.